Good day, ladies and gentlemen. I hope that everyone is well. This is Remufile speaking, Accounting 1A tutor for Dripanomics Tutorials Pty Ltd. Today's topic, we're going to be dealing with trade receivables and trade payables. In these series of videos rather, I aim to be as short and as concise as possible and keep the video short for you guys to be able to understand, watch, and be able to then engage with me later on rather. So trade payables and receivables. Actually, before we go too far, what are trade payables and what are trade receivables? So we know that we have what we call trade inventories, which is stock inventories, right? It's things that we buy and sell as a business. So that's where the term trade comes in. And a receivable, we know, according to conceptual framework, is the definition of an asset, right? A receivable is someone that buys goods from us on credit, right? So they owe us, hence why it's a receivable and it's an asset. And a payable is basically a liability. It is someone that which we buy on credit from and we owe and we need to pay at a later date or a later stage, right? So trade receivables and trade payables basically come from selling and buying goods on credit, right? Buying or selling goods on credit. Exactly. So this topic, trade receivable and trade payables, basically deals with the whole reconciliation part, right? So what is to reconcile? Allow me to actually go into Google and actually find you the definition, because I covered this in class, but many students did not attend due to transport issues and so forth, right? But that's not a train smash, right? I just want to get the definition of reconciliation. So according to Google here, right, I'm going to use all three definitions, but I want to focus on number 2 and number 3. Number 1, the definition of reconciliation is the restoration of friendly relations, right? So reunion. If you beef with someone, you then reconcile. You back to friendly relations. You're okay with that person, right? But more for accounting, we're looking at number 2 and number 3, which is the action of making one view or belief compatible with another. And number 3, the action of making financial accounts consistent, right? So when we reconcile our statements, we're basically saying that we want our things to be consistent. So what's said in one document ought to be said in another document, right? We understand that accounting is about debit and credit and balancing things out, right? So if we're dealing with trade receivables and trade payables, I'm going to give a quick example. If I am in the business of selling nyaube, right, to a customer, I am the seller, right? I am the seller, I am selling nyaube to a customer. By the way, I do not condone any nyaube, and I hope that there is no one who's going to watch this video while consuming any types of nyaube. This is just for example purposes only. I do not believe in nyaube. Right, so I sell nyaube to a customer. I sell my nyaube for 100 rand. In my books, we're gonna have 100 rand nyaube sold, but in the customer's books, it's what? 100 nyaube bought, right? So I am seeing a receivable in the customer, which is you who's buying the nyaube in this context, and then you as the buyer, you are selling me as the seller as a liability because you need to pay me at a later stage, right? So trade receivable, money expect to get from their customers for goods sold on credit. It's a financial asset. What, right? Trade payable, I basically just explained. It's also here in writing. And then we have what we call a purchase contract, which is an agreement between a buyer and a seller for purchase of goods and services. It is a financial instrument that, as it increases financial assets for one entity and increases the financial liability for another. So whenever there is a transaction that takes place, one is buying, one is selling. So a purchase contract basically gives rise to a financial asset for one company and a financial liability to another company. So here's an example. Our entities records purchasing entity, right? If you are what? If you are the purchasing entity, right, you are going to debit payable W, right? No, credit, I mean trade inventories and that. Why? Because you bought inventories on credit, so you owe your liabilities or your payable more, hence why it's credited. And then for the selling party, right, they're gonna have their amount debited, 86,250. Why? Right? Because they see you as a receivable. right? And a receivable is debited, right? I hope you guys can understand. So for the purchasing entity, they're gonna have credit payable W, but for the buying entity, for the selling entity, they're gonna have revenue debited because they have a receivable increase because they sold goods on credit, right? So initial recognition and measurement, we can come here. If both parties or purchasing and selling entities are registered VAT vendor, then revenue and trade inventories are measured at invoice amount excluding VAT, right? The trade receivables and payables are measured at the invoice amount including VAT, right? If the definition and recognition criteria of an asset and liability is satisfied, then the purchasing entity will recognize trade inventories on the credit as asset and trade payable as a liability, right? If the trade receivable and revenue satisfy the definition of an asset and income, then a selling entity will recognize the trade receivable as an asset and revenue as an income. Right? I think I need to stop my video here and then I will continue into my next one. Thank you so much for joining, guys, and I hope that you guys have questions.